let's do the brief introduction. Hey, great to be here. See you here at MIPIM. So I'm Dirk, working within CTP at the Research and Strategy team. Very brief, for those who don't know CTP, on the continent we are the largest listed owner, developer, manager of industrial and logistics real estate. And I joined fairly recently in October, so fairly fresh. And what have I kind of learned about the company in the last months? And I thought let's share 3 key words. The first one is about park maker. So it's really about logistic parks, which create scale benefits. You grow with your client, and you have you create ecosystems. The second one is about the in-house construction teams. That was new to me, but as you are, we are the contractor, the main contractor. You can kind of have better predictability about cost. You can assure the highest quality, and you can better time the developments. And we all know that construction costs have changed significantly over the last years. And the third word, what came up to me was actual things happen. So we're going to talk about logistics, but I think it's maybe too narrow. What we see within our portfolio, I'm sure in other portfolios as well, it's not only logistics. It's not only, to say it's very simple way, moving boxes. You see really practical things happening. A lot of high value add manufacturing, labs. That kind of stuff is what you see in typical, let's say, facilities, industrial and logistic warehouses as well. So in the next minutes, set the scene for a panel. And the first thing I would like to do is a very simple way is compare our sector with the economy and with the office sector. And what do you see on this chart? You see a comparison back to 2009 of the economy. See, GDP in Europe has grown by around 12% since 2009. When you compare it with the growth of the office stock, the occupied office stock, you see roughly the same growth. It's quite correlated with each other. But then logistics, growth of occupied stock, more than double. Significant difference when you compare it with the economy and with the offices. We have seen so far, and I expect that we continue to see an outperformance. Why? Because, and that's kind of repeating myself, the structural drivers we see in the sector. And I'm going to talk about that one a little bit later on. So this is one perspective. Another perspective I would like to share to set the scene is to put our sector more in the businesses of our clients, of the tenants who use our space. And what are you seeing here is, let's say, the total cost they have and the role of real estate. For a typical logistics operator, the biggest cost factor are transport. That's the biggest one. Payroll, labor is a big one. But real estate, let's say, the industrial logistics is around 5%. So that's limited, and that's really impacting location decisions. And one thing I really think is different of our sector versus other sectors is that our sector has, in my view, really transitioned from pure cost center, where the clients say, hey, we need to pay the rents, that's it. But it's something we really need to have, but prefer not to a driver of revenues. Because the right location, the right asset, can really, for instance, support on lowering transport costs, be more efficient with their locations. So far I talked a lot about growth, structural growth, the outperformance versus the economy, but I see constraints as well. And I see constraints in terms of land scarcity. That is here to stay by far. And something else I would like to share today is about the constraints, is about regulatory. What you see on this chart is the number of months to obtain your permits. And you see that we call it growth markets, like for instance, Poland, Serbia, Bulgaria. It's fairly limited to get your permits. But when you go to our core markets, like for instance, Hungary or Slovakia, it's already getting more challenging. When you go more east, good luck. You need to be very patient. It takes a long time to obtain the permit. That tells me that there are structural constraints in the market today and in the years to come That tells me that for our sector, which I think is a positive from a long-term investor perspective, that it is not that easy to switch on demand in most markets. So that really creates structural constraints in our markets. And it tells me it's really complex. When you talk with the regional teams, about all different aspects of permitting, it's not that easy. So we talked about growth, how our clients look at it, constraints, brief snapshot for a panel discussion just about, the real estate, how we're doing as a sector. So on this chart, you see on the left axis, it's not the best chart at the end, but when you look at the time, but anyhow, on the left axis, you see million square meters, net absorption, change of occupied stock and completions, and on the right one, you see the vacancy rate. So since, let's say, the period 2017 to 2020, our market was already really expansionary. You really saw that vacancy rates were around back then around 4%. Supply, demand was around 70 million. Great time. Then we had 2021. Remarkable years. Record after record after record in many markets. Vacancy moved to many markets on average to 2.5%, even lower in, for instance, German markets. Demand and supply went up above 20 million square meters. Crazy years. Now, what you are seeing in the market is, or you could say on one hand a slowdown, but I would more say, a stabilization and moderation of the fundamentals. When you compare 2023 versus historic perspective, it is not that bad at all. We still, see strong demand in the market. Vacancy is ticking up, but still we are really close to historic lows. So I think that's all positive. When you look at the occupier market, you see that the tenants are still willing to expand, but are more cautious. Not a surprise. But what I think will really change in 2023 is new supply. So the last 2 years, it was record. Now, even some say in markets it will fall off a cliff. I'm not sure about that one. But when you look at development starts today and at levels under construction, it is really slowing down. And even in the development hotspots, like Poland. So overall, so far, I'm quite positive about the market. Why? And in the beginning, I already mentioned the structural drivers of a sector, and that applies all over Europe, CE as well. And I would like to share some drivers shaping, in my view, CE's growth potential. The first one, and this is really high-level overview, it's about, I call it business smart. CE is business smart. When you, for instance, look at labor costs, it's 1/3 in, let's say, industrial logistic warehouses versus the West, 1/3. You have a lot of manufacturing employment. It's a long tradition of manufacturing in that region. And you see a really evolvement of the infrastructure. The second driver is untapped nearshoring demand. You really see in the market, due to all the political trends and all the risks, you see the risking of supply chains. It's really important, and CE is benefiting of it. CE is already a kind of manufacturing hotspot of Europe, and that continues. For today, I looked at one number. How much is the manufacturing volume of just finished goods? CE versus as a ratio in the EU 27. Back in 10 years ago, it was 11%. Today, it's already 19%. So that share continues to grow. Diverse and expanding e-commerce. We continue to see that across Europe. Of course, 2022 was a strange year, where you saw that e-commerce sales in many Western markets were on hold. But look at the trend pre-pandemic. Then we are still above those trends. So we stabilized, but I believe in the long-term potential of e-commerce. And for sure in CE, you see as the market is underdeveloped, it's catching up, you see continued growth. You saw in Salesforce market stats that, for instance, in Q4, online sales in CE continued to grow by 11%. Economic outperformance. For the next years, when you look at just IMF stats, you see growth of the economy double as fast as Western markets. When you look at, for instance, the capital cities, the biggest capital cities, outperform the countries. And when you do a ranking, you see that Warsaw, Bucharest, and Budapest really top the ranking in terms of GDP growth. And this applies for almost every market in Europe. It's about the real estate fundamentals support the outlook. Markets are constrained. For me, a real positive is that the vacancy rates remain low in many markets, and due to those structural drivers of demand, you continue to see cautious but optimistic demand in the market.
Let's just do some quick introductions. Let's start just with you, and everybody has got a minute in order to say who they are, what they do, and also, I guess, which markets you are operating in, so that then everybody's aware of which parts of the market we're in.
Dirk of CTP.
Yeah,
we already talked about it. No, so in the beginning I mentioned 10 markets. 7 out of 10 are in CEE. So we are really active in the CEE markets: Poland, Czech, Slovakia, Hungary, Romania, Serbia, Slovakia. So a lot of one thing what I really like in that part of the region is the diversity you see as well across the different markets. So you see really mature markets like Czech, while others are really emerging and really growing. So diversity.
Okay, super. Frank.
My name is Frank Perschke. I'm the CEO of P3 Logistic Parks. We are a developer and investor of logistics property on a pan-European basis, so we're active in 11 countries. We own a portfolio of around 8.5 billion euros, which is split a bit more than 60% in Western and Southern Europe, and the remainder in Central Europe. The biggest markets for us are Germany, Czech Republic, Poland, Spain, Italy, and then the rest of it. So it's a diverse portfolio.
Perfect. Will.
Yes, my name is Wilm Schwarzpaul. I'm managing partner of EcoParks. We are a little bit the startup in this round, I would say. But I also worked for a pan-European player on long term in the past, so I know this perspective. But we actually now operating really with a focus on the German market, and our target is really to be we want to really move forward in terms of really economical and ecological real estates in the logistic markets.
Okay, perfect. Christopher.
Hi, nice to meet you all. My name is Chris. I'm the head of European investments for WP Carey. WP Carey is a company, is an investor specializing in acquiring what we consider to be mission-critical real estate, or real estate where there's a very quantifiable, understandable importance for the tenant and a really strong connection. And that naturally means we tend to gravitate strongly towards industrial real estate. And then again, even further into logistics, which makes up in aggregate about half of our global portfolio, which currently stands at about 25 billion US dollars. We are active all over Europe, and it's a region we're very comfortable in. We have investments in 20 different countries. And it's exciting to be here this year. There's actually a lot to celebrate for our company. It's our 50th anniversary as a business. It's 25 years as a public listed company. It's 25 years that we've been investing in Europe. And our Amsterdam office, which takes care of asset management, they've been around for 15 years. So a lot of good anniversaries to be here this year.
That is a lot of anniversaries. Yes, great. Laurie.
Happy birthday. I'm Laurie Lagarde. I'm the head of the logistic division of CBRE-IM. We have a bit less than 13 billion under management in Europe, covering 11 countries. We are an investor operator across several asset classes, logistic being one of them. And investing and operating this asset class for many years, one of the top 5 in Europe.
Great, and we also wanted to pick up, industrial within this, light industrial as part of it, because it's part of that overall sense. And so, Wolf, over to you.
Thank you very much, Richard. Exactly, that's what I do. I founded Stonewest 3 years ago. We focus on mission-critical light industrial asset. The strategic approach is to say businesses do not need to be and actually should not be owners of mission-critical production properties. We are focusing on mid-sized and in this moment mainly German corporates, and building a portfolio from there on beyond Europe.
Great, thanks very much. Let's and of course, if you've got any questions, please do let me know, and we will make sure that we answer those for you. Frank, let's start with you. It'd be good to get, I suppose, your sense. We heard there from Dirk about some of the opportunities that the markets seem to be, stable in terms of the fundamentals that all seem good. So I guess what's your take on that? How do you see the last, 12 months and how do you see the market at the moment?
Yeah, I mean, the last 12 months certainly have been interesting. Yeah, but I think it's important to really differentiate between the demand side of the business and everything which is in context of the capital markets. Because and I completely agree with Dirk, as he described the market fundamentals on the demand side. So there are tailwinds which have been even stronger now than in the past. Yeah? So with e-commerce being a driver, nearshoring and occupiers wanting to make their supply chain more robust, all this drives the market. And these occupancy rates which we see, or the vacancy rates which are at historical low levels, show how active the market is. And this is combined with significant rent growth, which we have seen over the past 12 months, which has been much stronger than in the previous 20 years or so. You know? So this is very healthy. Having said so, of course, even this asset class, which I believe is the strongest compared to the other ones, is not unimpacted by the developments on the financial markets. You know? So the increasing interest levels had an impact on cost of debt, had an impact on expectations on equity returns, which had a negative impact on property values, which we have seen developing over the 12 months, partially caught up by the increase in rents, but for most of the players with some limited negative impact there. And I think the world was uncertain already before, but now it has become visible to all of us that it really is, and which has chances and risk. You know? So we all don't know how the market is, and we have seen last week what can happen and how sensibly and sensitively the markets react. But at the same time, we have seen, or we are seeing, opportunities which are more attractive than 12 or 18 months ago. So we stick to the buy side, and continue our expansion and look for opportunities which didn't show up 18 months ago.
Okay, good. Laurie, it would be good to get a sense from you, I think, as well. Frank there mentioned some of the challenges. Obviously, if we'd have been talking about it a month ago, we would have assumed that the 50 basis point rate rise that we're likely to see this week from the ECB would be the end of that cycle. That's what the markets were pricing in, and now it doesn't look as though it is the end of that cycle. And so there's a bit more uncertainty. We've got the sort of banking issues in the US just come through. So I suppose, how do you see that? Do you expect to see a little bit more uncertainty, or do you think that actually logistics is so strong that it's going to kind of power through all of that?
Yeah, well, I agree that 10 days ago it was a different story than potentially today. And I don't have a crystal ball, but I have to say that I'm a bit more uncertain today than I was 10 days ago. The one thing that I agree with Dirk and Frank is the fact that the logistic market has strong fundamentals. The demand is there. I mean, I'm repeating, but the vacancy is very low, and we can see in our portfolio that we are increasing the rents almost everywhere. So which means that the occupier demand is really strong. This is boosted by the fact that there's not e-commerce is still there. Okay, maybe it has been reducing a bit, but it's still there. The nearshoring activities are developing more and more to Europe from the consequences of the war, from some of the issues that we have on the macro side. So that helps the logistic market to be strong compared to other sectors. And so my strong feeling is long-term, this is a sector that is going to be outperforming. But for sure, 2023 is a difficult year. And in terms of expectation in the next few weeks, I have to say it's a bit more uncertain than, 10 days ago.
Okay, good. And Wolf, what's your perception of it? How much is it, I suppose, affecting your part of the market, the light industrial side? Is that more kind of rock solid? What's your sense of it?
An increase in interest rates helps investors like us, because the alternative of getting cheap debt for corporate and continuing to hold his own asset becomes less and less attractive. Second, I think to your point, Dirk mentioned the constraints of creating for the creation of new assets, and I think that's an overall phenomenon in Western Europe. So that will for sure drive values up, because simply the supply side versus demand is such that rental levels should over time increase. On the classical logistical side. On the light industrial side, as I said, high interest rates create more opportunities for investors like us, be it WP Carey or even mid-sized, smaller boutique businesses like ours. And in addition, you, Laurie, mentioned it already, there's an supply chains are shortened, and businesses will, over the next time, especially in view of the American-Chinese antagonism, concentrate more on where the business is at home. And whether this is in the Czech Republic, or it's in Portugal, or it's in Italy, or it is in Europe's powerhouse still, it is in Germany, that will lead to the situation where businesses will decide, where do I allocate and where do I grow? Where is my basis? And do I do that with my own sources? Do I get bank debt, or do I consider my mission critical real estate to be a tool in financing my business?
Okay, good. And Christopher, it would be good to get a sense, I think, from you, I suppose, of what are some of the structural, I mean, there's some interesting discussion there around the structural drivers that we're seeing. How do you see that developing? Where do you think the sort of, the main drivers are going to be? Because obviously we're probably going to have slightly less development at the moment, one would assume. So therefore there will continue to be restricted supply. And if we've got all of the things like nearshoring, all of those elements happening, then that should push up rents. What's your take on it? I suppose what's driving your investment in it?
It's an interesting time that we're in right now, and I can see already Wolf and I, we will be good friends, because we seem to have a very similar view on the world at the moment as to what's going on and what's driving the market. I think it's no surprise that at least looking at Europe and maybe contrasting it to the US, which is the other large region that we invest in, we're still somewhat more in the transitionary phase. I think we're lagging, call it 6 to 9 months behind in adjusting to this new environment with high interest rates. And that is going to be the main driver going forward as well. And in the long run, it is. Now, fundamentally, I think we can all agree the logistics market in Europe or industrial, the fundamentals are very, very strong. There's no arguing around that. And I think the long-term view is very favorable for all the reasons we already discussed. And I have no doubt about that. But it still begs the question, how do you deal in this current transitionary phase as we're moving from one level of interest rates to another? And what are the correct investment decisions to make in this environment? Now, we do have a very, very luxurious position that we are an all equity purchaser of assets, so we don't really need to consider bank debt in our underwriting as a source of capital. But nevertheless, you want to benchmark, and certainly as a REIT, where as a REIT investor, it is really about your cost of capital and the spread you can generate relative to your cost of capital. That's what at the end of the day drives your return and makes a good decision for an investment. And it's difficult, I'll tell you that, because rates will likely still keep going up, and they might be, in a way, we should probably all be happy that that's happening. I think the interest rate environment that we had the last 10 years, historically, it's probably the aberration rather than the normal. We were just stuck in this environment for so long that it felt normal, but it is actually unhealthy for a market to be operating at such low levels. And we're seeing that now with dislocations across all kinds of asset prices elsewhere. So to your question, what makes a good investment in this environment? What's happening? What's driving investment? I think while the fundamentals are so sound for industrial, and we're all very favorable, and sort of our in-house view is very favorable, it is a tricky environment to be investing right now, because I think, and again, specifically in Europe, the acceptance is not yet quite there, that we are entering a really new interest rate environment. And there's still a lot of reluctance to accept that from quite a few market participants. And that's going to choke up the market a little bit before we enter a new normal that we can all agree upon as being a new environment. And then I think activity will resume.
Okay, that's interesting because a lot of the market was pricing in previously that there might be, that this would be the last rate rise, then there would be a pause, and then rates would actually start coming down again in the autumn. But that's obviously not, that's not looking like the same thing. But you've got a much more pessimistic view on it, that actually rates will continue to go up and stay up, essentially.
Yeah, but I don't necessarily think that's a pessimistic view. I think if we all agree that, let's say, a fixed year, 10-year, 50 LTV mortgage all in costs you 5%, if that's kind of the market expectation, okay, then that's what the market prices in, and over time yields will adjust accordingly. And likewise, if the expectation is that that is at 3% or 2%, yields adjust accordingly. It's just getting from, let's say, stage 1 to stage 2, that transitionary phase, that is quite painful, frankly, because there you will have some very unhappy sellers, and you will have some disappointed purchasers because they can't find the stock that they think is priced at a level that makes sense for them. But once that level is settled in, then that sort of the market starts to kick off again. So I don't think it's necessarily a pessimistic view. I just think we will need, unfortunately, more time to get there.
Okay, interesting. And again, yes, so that was what I was going to say. Anybody can come in at any point.
I think Frank has the best insight here, because after all his years managing Eurohypo, he will know better, definitely, than I do, and maybe some others of us. But I would believe that going forward, the equity return of the lenders will be a decisive criteria, and that has not been the case of the past decade and longer, because equity levels in banking were so low that the relative return of that low equity did play a certain role, but Frank, correct me if I'm wrong, but not the decisive role in the pricing of the debt. And I would expect that, especially what has happened over the past days in the US, that there will be again an increased discussion in Europe about the equity levels of the European banking industry as a buffer or a security buffer towards their exposure.
Okay, good. Frank, did you want to pick that up, and then I'll come to you, Will?
Well, I mean, we know from the past why real estate banks go bust, yeah, because of write-offs, and the rest equity returns is like, is it an okay level of returns or a bit worse or a bit better? But the write-offs kill the banks and make the difference. Yeah. So and in the banking business, what we are seeing currently with the new regulation, it has improved significantly since the great financial crisis, because the equity buffers are higher. So this is certainly good news. I mean, I think the example which we saw last week, where the reasons for the problems of the Silicon Valley Bank, I understand, were that they had to invest the money they had given to by the clients into something, and what they did was, well, they invested long term into bonds which had lost significant values, and that's of course one of the challenges for any bank balance sheet, is that you have to synchronize your investment side as with the money you have in, and if you have an imbalance of the maturities, then that puts a risk on you, and that has happened. And well, normally you would expect the banks to be smarter by now and not to run an open-end risk on the maturity profile. Yeah?
Yes, you would.
I wanted to pick up on one of the other trends, because obviously, Willem, the Eco Parks suggests what you're doing in a way. The company is well named from that point of view. And obviously ESG, carbon neutrality, huge mega trend driven by obviously the requirement to reduce the CO2. So I suppose, what are some of the trends that you're seeing, and I suppose how is that driving the kinds of designs of the parks that you're building?
Yeah, maybe one sentence to the follower speakers. I think the interest rates are changing back again. We could possibly say the main thing we're struggling now with, and this of course influences a little bit, but I think we have to look over into a further perspective, is that construction costs have raised that far. So we're actually back to interest rates that we were used to, not in the last maybe 6-8 years, but before. But the construction costs have just been growing up extremely, and that's what really conflicts now the decision for developments. If we look back a couple of years, ESG was going more and more into focus. Of course, we had this crisis of the last 2 years where you have to rethink how, at the end, the developments can still keep economical attractive. But still we think, and that's what we put on our, let's say, flag after, as I said, I worked also for a pan-European developer. We did a lot of square meters across Germany and Europe, is that we think we are at a time where we can really create and build. The innovation level is there, the technology level is there to create green logistics spaces. So we can really take sustainability more into the focus. And that's what we decided as eco-parks. We want to go ahead. We want to bring in a new standard in the market, which is actually could be state of the art, but it's not the common practice enough as we see it in terms of the challenges we have, not only on the economical side, but we have the climate change, et cetera, et cetera. So, and the energy crisis. And we think that what we've seen in the first project, that in terms of resource supply chain, it helped us to go this way. It helps in terms of and our clients in terms of the energy crisis. So to make this move to go to fossil-free on logistics spaces, which has been a big topic, at least in Germany, I can say, in the last 12 months, where warehouses were redesigned to heat pump because no one knew how they're going to be safe on the energy in terms of supplying the spaces with gas. So there is also a big opportunity in taking this road faster to be more sustainable. And we've implemented in the first buildings we have under construction now, or we have finished one in January, and we think there's much, in German we say, much air to the top, or more room for improvement, and we want to move forward.
Yeah, and maybe one thing about ESG, what I think is really interesting in the last months, year, is so you see that you saw it 5 years ago from the investors requiring it. Now you see it from the clients as well, the users of the space as well. And when I visited the client, it is like, yeah, I really need as soon as possible those solar panels, because we committed to. I'm willing to co-invest in the heat pumps because we need to go green. So it's not only, let's say, from the investor or let's say for the better world, but it is really a need from the client as well. And one thing, for instance, just to share is, which is public, is DHL published by 2000 investors, developers, be aware by 2030 we will only lease carbon neutral. We only lease development carbon neutral. So there is a push from the client side as well. And I think that's an interesting kind of combination you are seeing in the market.
And the companies that are doing that are obviously DHL I'm familiar with, and also they can have no gas coming into new developments have got to be all electric as well, which is interesting. But I suppose, is there a sense at the moment that that's being driven by those companies' own sustainability goals? What's driving that? Because obviously also cities, regions will have, I think there's a really interesting fit with cities and regions not being helpful, to your point there, particularly in Western Europe with logistics planning. But maybe if they were carbon positive even, because the ability to be able to create solar power from the roofs, actually that might be beneficial to everybody. I don't know if anybody's got a take on that side of things, really.
I think it is happening now, yeah, as you said. Yeah. So originally we felt that we were pushing for it, and the tenants were rather not really interested and just focused on price. And as the minute it cost some money, they were like shying away from it. Now we have the pressure coming from us, the investors, from the tenant side, and also the municipalities, who combine permits more and more with ecological requirements. And so I think there is, on an abstract level, there's a high level of alignment, but the devil is in the detail. Yeah? So whenever you try to really work on it, and I take the example of solar panels, yeah? So trying to implement solar panels in 11 countries is quite a challenge, because the regulation is different everywhere. And then when you plan it in detail, yeah, even the technical requirements have not been developed to a standard. So everybody's used to these high-level statements which commit on an abstract level, I mean, it's not even clear what carbon neutral means at the end of the day. So, but even putting in solar panels, then very down to earth requirements, like how do they look like? How do you deal with responsibility between the tenants, the operator, if you're yourself? How to get insurance on it? How to clean snow on solar panels, and such ridiculously sounding details. But we found out that we got the impression that hardly anybody else was going to that level of detail, and now we are implementing it on that basis. But there is not common market practice yet as it is in other fields. So I think the more we push it, and we will get to it in a few years' time, but still we are in the midst of this development.
Yeah, I agree on one side, but the question is, how can these questions be answered and this integration go faster and easier? And if I just think about this certification of buildings in German, the GHG standard, it was 6-7 years ago, everyone was saying, okay, we can do it, but it's too complicated for all these subcontractors and so on. Now it's common practice. The industry has changed, it has accepted, and no one is discussing anymore if there's a building that is not certified. So it's actually standard. And the same, that's always when you bring these things forward, of course, you have to answer these questions to make it market ready. And just maybe one example, we had our first building that we just realized. It's a German KfW 40 standard with not so much modification. It has a wooden structure which makes it the only chance to make a CO positive material realized. We have fossil free. We have PV as concepted in the whole energy concept. And we were, of course, challenged to market price it. The wooden structure at this time was actually the more economical one because the concrete market was really super hot, and the prices too, of course. And we moved forward. So, as I said, we built a lot of warehouse in the past, and we said, okay, we think it must be possible, and we did it in the first building, and it works. Of course, it helps if we together answer some of these questions together, that there's no question anymore why or how can you implement photovoltaic systems on the roof, which only makes sense. It's you really create your own power stations within the building. So we have to take this opportunity, and we have to answer these questions.
Yeah, I think it's an interesting one. I'd also be interested to pick up on something that came up actually in the residential one, which was that there was a real drive at the moment because of the focus that there's been on energy, but actually to have everything included, so that energy was part of the amenities that were being charged, and they were happy to be charged more rent in it, but they wanted some certainty on what it was that they were going to be paying. Is that also the case for companies, I suppose? Is there a desire to have that as part of the rent as opposed to them paying separately for energy? Any thoughts around that?
I don't know, but we would never accept it, because that's something which, I mean, that's a risk which you don't want to take as an investor. And we have seen that in the past where you had amenities included, and then you had price increases there, which can kill an investment. So this is much closer to the operational side. So I think it's important to help to find concepts which are saving energy and saving cost as much as possible. But I think we wouldn't be going for it. Yeah.
Okay. Maybe one thought to that. I think I fully agree. The chance that we bring in with providing the energy on site is that we can provide our tenants energy to a certain good price. If we take the electrical costs in the last year, which were ridiculously, were sometimes 10 times more than ahead of the crisis, if you then have an energy safety by creating your own power, you of course have to sell it to the tenant. Then that's a big benefit for the location, for your building.
Okay, good.
I mean, I mean, obviously, all of these ESG considerations are super, super important, and I think the real estate as a whole, we don't have a particularly good track record when it comes to CO2 emissions. So this is here to stay. I think for us, where it kicks in a lot is on the assets we already own, on our existing stock. Given that we're such a long-term landlord and long-term owner, we have to be alert of that. You have to be helping your tenants to make sure that the space meets the requirements in the long run. So for us, it's both a consideration on obviously new developments and when we invest in those, but just given the scale of stock of available buildings that are already out there, I think we see huge opportunities there in terms of retrofitting, in terms of installing solar panels, and you name it. And your point regarding the energy cost is a really good one. We've certainly seen an uptick in tenants asking, hey, can you help us, support us? Can you provide funding to put solar panels on the roof and provide some more of your own electricity? So it's definitely here to stay. And it's demanded from everyone. It's the investors, it's lenders, it's obviously the tenants themselves. So going in the right direction.
And the tenant will first of all decide when he leases a property, for sure. But what about if the technological standards change over time and he's just a tenant and he has zero influence under his lease agreement, but he is obliged because he is listed or he has lenders or his corporate governance requires that his the space he leases fulfills these modernized and changed ESG criteria. So looking forward, I would expect that in negotiating leases for the long term, the tenant will want more say in an adaptation of a building to ESG requirements. So yes, I agree with Frank that we would probably not want this as a landlord now, but I'm afraid that we'll have to accept that strong tenants will require from us that we adapt buildings to changing ecological requirements over time.
And Laurie, what's your take on it?
Yeah, well, I agree. I mean, I think that for us, in every single decision that we are making on development, investment, ESG is fully embedded in those decisions. We have the ESG head of ESG, MEA, and global that are part of the EIC, so which is very important and a change. So that's really good. And we can see, of course, both investors but also tenants that are pushing, to get ESG embedded in those buildings. It is much easier on developments to do it from the start, for sure, because you can build whatever you want on those assets that are part of our operating portfolio that are much older. I agree that it's difficult to put that in a way that it's more proactive, but we're working on it. And the good thing about looking at all these options in order to get those builder more greener in real facts, in a more scalable way can be achievable for some of these implementation. And solar panel is something that is, I agree, country by country, even jurisdiction by jurisdiction. But it's a very interesting topic and very important to take care about. Yeah.
Okay, good. I wanted to pick up a bit on locations and where we see opportunities. So maybe just a quick one. Let's start with you, Frank. In terms of you're across a number of different markets there. Do you see them having all equally good opportunities, or are you focusing a little bit more in terms of strategy on some markets rather than others? What's the position?
I think for a start, we have to be careful with defining the regions. Yeah, so that was probably where I would disagree with the introductory presentation, where CEE, there is no such thing as CEE. Yeah, so if we look at CEE, there's a huge difference between the Czech Republic, which I count more to the western side of Europe, with Romania, for example, and there's quite a gap, and the difference between Germany and Czech Republic in market behavior is probably narrower than between Czech Republic and Romania, at least to our experience. Yeah? So I think both have pros and cons, and one of the challenges in the Western Southern European market, including Czech Republic, the restrictions on developing logistics, of course, makes it difficult to develop. But once you own, then it protects you from future competition, and that's certainly an advantage. Whereas in other markets, which may be very dynamic for developments, but of course that may continue in the future, so competition will grow as quickly as that. Yeah? So having said though, we have a very balanced approach. We look at both Central Europe and Western Europe. Just the pure size of the market suggests that in our case, the proportion of Western and Southern Europe will probably increase over time. but generally the general drivers of the demand drivers of logistics are the same in all the markets.
And is there still, Dirk, I mean, in terms of e-commerce, obviously the UK, very well developed, other European markets well developed, and Laurie mentioned we'd seen some tick back, in fact, in some ways in terms of Amazon and those kinds of things. Is there still a lot of room for growth, particularly in those Eastern European markets that you mentioned?
Yes.
Okay, good.
No, so first, yeah, you mentioned Amazon. What's really interesting, what I was not 100% aware of, was that when you look, for instance, at Amazon, their market share is, let's say, around 50%. Only in Germany, France, and the UK. There are big players there. In the other markets, they are medium or they are even not active there. So outside of those markets, you see much more, let's say, diversity of different online retailers. A lot of domestic retailers as well. Overall, in, let's say, yeah, CE, and I fully agree, by the way, that here Czech is a big exception when you look just at penetration rates, which is more Western than Bulgaria, which is low. But overall, you see that the markets in CE are really catching up. When you compare, okay, when a market reached 5% penetration rate, how fast did it go to the 15%? It took some time in West. Now in Central Eastern Europe, it's going really fast. But in CEE, and I would say for Southern Europe as well, markets are catching up at a faster rate than in the more mature markets. But on the other hand, in the more mature markets, you really see, and they have seen for already, they really benefited of the demand capitalizing already on a big scale. So for every country, there is a positive there.
Okay, good. I'd be interested just to pick up a little bit on capital, maybe with you, Laurie. Just what are you seeing there? Are you seeing a pause in terms of capital in general, but particularly for this sector? Are the investment managers keeping their powder dry because they think that the market is going to settle and there'll be more opportunities coming up? What's the situation? And I suppose, is there still institutional investment looking particularly at this?
Yeah, so it's a mix of some of these investment managers that have dry powder and looking for the right opportunities. We just talked about looking at where the yields are going and may move again. So looking at the opportunities where they could deploy the capital. On the investor side, I think it's a mix of people that are posing and others that are investing depending on the strategies they're looking at. But generally speaking, a more hold in terms of investment that we can see everywhere. Where we'll be heading, I think it all depends on, the macro that is currently happening, interest rates going up, and, this uncertainty around where the yields are going to be going from that moment. So let's see how it's going to go in the next months, quarters. But for sure, what we see from our side is that there's still some, in terms of the equity that would be like to be invested in which sector. Logistics is one of the one that is being picked up together with residential, but those two would be the priority of investors. That's what we see.
Okay. Yeah.
Yeah, we do observe a certain change because until a year ago, the last 2 years before that, a lot of non-specialized investors came into logistics, and very aggressively at high price levels. They have slowed down again now, So you have more the focused and specialized and educated players playing a more eminent role in the investment side by now, which I personally think is healthy because the market gets overheated if those dominate who do not have the operational know-how and the specialization, but they just jump on a market trend. So I think this is helpful. So it is a differentiator again to have money because this had disappeared. So we are fortunate enough to have GAC as backer, so as a shareholder. So we are one of the investors who stays on track and continues that. And of course, availability of debt has decreased significantly, which slows down development, which is not too bad for the market at the same time. So I think overall, this is more a healthy development, bringing us back to more normal circumstances, rather the red-hot market, which it used to be until a year ago, which could not have been sustainable. Yeah? And the higher it goes, the riskier it gets. Yeah? And now we are at and we all, or at least I don't know how things will develop over time, but at least I feel more comfortable on the levels we have today than on the levels which we had 12 to 18 months ago.
I would completely agree there, Frank. I mean, yeah, I think you said it really well. It's got to be a much healthier level, much healthier discussion, and it's not a bad thing necessarily what's happening right now. It's just a transitionary phase. It's going to take a while. We're going to get through this, but yeah, I would agree with you actually on that one.
Okay, good. There's around 7.5 minutes left. So has anybody got any questions? If so, raise a hand and I will come to you. I'm scanning the room now so that you've got about 10 seconds left to raise your hands. Otherwise, good. Okay, if you do have any, do ask those questions and we'll come to it. But I wanted to pick up with everybody, I suppose, when you're looking at the market at the moment, we'll pick this up as a kind of final thought, I think, really, which is, I guess, where do you see the biggest risks to your strategy at the moment, and where do you see the biggest opportunities? So I guess what's the main challenge, and then where do you really see that there's an opportunity from an investment perspective? Anyway, let's start this way and work that way down. And so Dirk, which gives you very little time.
Yeah, exactly. I hope it went that way. But
yeah, I can see that. Yeah.
No, a risk. I would say one theme is about predictability. You see a risk among our clients, or let's say a recent pain point they have is about predictability. So they had COVID, they had the whole supply chain disruption, and Ukraine war, everything, construction cost. Where is it going to? What is the right stock level in my warehouse? So that predictability is something they struggle with. Predictability, for instance, what I mentioned about permitting. You know, how fast, when do you can really expect it? Those kind of predictabilities, that's for me one of the bigger challenges. One other thing is, we didn't really touch about it, but it's about the image of a sector. That's something which is a risk as well. We are really at the bottom of a wish list of many public authorities. They say, I like to have just a box in the backyard. So that's a challenge. Opportunities. Yeah, there are many. I think now with the whole de-risking, decoupling of supply chains, which is a long-term trend, there's a lot going on, combined with the whole energy transition you see at the global level. So where I, for instance, to be more specific, where do we see an opportunity is, you see now more and more in the news, like, what was it last week? Mercedes-Benz opening an EV factory, kind of manufacturing. And that attracts, again, suppliers. That is here for the long stay. That's really to create, let's say, the made in Europe economy. So I believe in that. I really see that as an opportunity. The whole nearshoring trend, made in Europe trend across Europe.
Okay, great. And interesting you mentioned there about the image of the sector, because I know, Frank, as well, we were discussing earlier the fact that actually it's becoming increasingly difficult to, not only do the tenants have challenges in terms of recruitment, but that's also true of the sector.
Yeah. I mean, this is true for all sectors. To find talent, that's certainly among the challenges. And all of us in this sector have grown significantly. So and we are we're looking for the same kind of talent. But again, I think logistics is getting more sophisticated. This is getting better. It depends also on the way we behave. Yeah? And if we become more sophisticated, the talent we will get will be better. Yeah? But coming back to your previous question on risks and opportunities, I think the one very important thing is we shouldn't take the demand side for granted. Because we are spoiled in a way, because for the past years, this has been so successful. But of course, if the general economic environment did worsen significantly, it would have an impact on the demand side as well. So we always should have a close watch on that dimension and make sure that we develop and we maintain product which is suitable to the needs of our tenants and our clients. So that's on that one. And then on the risk side as well, as like we need, of course, for investors of big capital for the long run, a certain stability in the financial markets is a must. Yeah? And if this is not there, then it's really getting more difficult. But again, on this healthy level, this is also the opportunity side as well, because there, at least for those who know what they are doing and have the capital available, we will see more opportunities in the next month and probably years to come, rather than in the years -1 and -3 years, so in the past. Yeah? So that's, I think, it's a lot of opportunities combined with the tailwinds which we discussed. Yeah? So I think there's overall very positive outlook for the sector.
And Richard, one small thing, what I mentioned with image sector, I mentioned image towards public authorities and, for instance, the public opinion.
Okay, all right, interesting, good. Willem.
Yeah, I think the main risk is really the uncertainty of this moment, which will make it more complicated in the next months. Also, if it accept it's some kind of transition phase, this will then bring new opportunities once we have kind of balanced out the new then. One main risk which we didn't actually mention is especially I think it's not a German typical issue, we see it also in other countries, is the shortage of the land. So the product logistic on greenfield will, in Germany it's almost going to, I would say brownfield has overcome the greenfield developments. So that's an issue, which land is accessible and with which image are we able to access the land, because communities really are being more and more straight or limited on giving decisions to develop land for logistics. So we see an opportunity there is that this pure core logistic must have to adapt to more maybe light industrial elements included, production. And when you come to different spots, to more city locations with brownfield developments, it also brings other typologies and maybe asset classes into this. And that's what we also think sustainable development has also to be a concept that is really the genius loci accepted to make the best for the location. And what we have done in the past and has been the main focus was, greenfield development is, it will change very clearly, I think, at least in Germany, and I think also in other European countries, that this is possible.
Okay, great. Christopher.
We want to grow, we want to invest, full stop. Not just for the sake of growth, but really to expand our portfolio on a nice and sustainable trajectory. So the biggest challenge I see is finding enough opportunities that make sense in this environment. That's the key challenge. And key opportunity, also quite straightforward in this environment, for more companies to realize how much capital they have locked away on the balance sheet by the real estate they own, which they should reconsider selling to us. So that's the main opportunity. There you go.
Great, Laurie.
Yeah, well, on my side, I kind of agree on the fact that uncertainty of the moment is the challenge currently. When it's going to be settled, it's going to be a bit better. However, on the opportunity side, I think this is the right moment to look at potential opportunities on the market, and I'm expecting in the next few months that we're going to be forcing that. So that's my view.
Okay, great. Wolf.
Thank you. More opportunities than challenges for me. Logistics has very well settled as a market segment within the real estate investment world. Light industrial is the next field. Light industrial is still early mover, but probably a few years on, light industrial will be equivalently strong than the logistics sector within the overall concept of industrial properties. Therefore, more tailwinds than headwinds. Some headwinds, I agree, from the leverage side. Real estate is typically priced in a combination of equity and debt. And we have uncertainties of how the debt market will move. This creates, however, in my opinion, more opportunities in the short run. than challenges.
Okay, good. So more opportunities generally, which is good. Quick show of hands here. Who feels positive about the logistics sector in 2023? Well, I think that's a very good place to end, everybody. Thanks very much. Thank you for joining us here. Thanks to the panel. This session will be followed by one on debt, and then there'll be one on ESG. So if you could join me in thanking yourselves and the speakers for being here, there will be a 1-minute swap over, and then we'll be on debt. Thank you, everybody.